With the market taking a beating these past few days and the headlines screaming doom and gloom, join us this week as we talk about the big question on everyone's mind. What are the predictions for 2025? We have another blockbuster year, or will we be in for a rough landing? We'll find out.
Welcome to Label on Fire with Label Sternbach, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. Ladies and gentlemen, it's time for Label on Fire.
Welcome to this episode of Label on Fire. I'm Freddie Bell, and I'm with Label Sternbach. He's Amazon's best-selling author of Living with Financial Anxiety, and he's also the author of Authenticity. Label, hello, and welcome back.
Hey, how are you doing this week?
Unbelievable. Glad to be with you. And the big question on my mind, and I know on a lot of individuals' minds, is 2025. What will it look like? Do we think we're headed for another blockbuster year? What should retirees prepare for as maybe there's a rough landing in store for us? And what factors are you watching most closely? That's a loaded show right there, Label. Where would you like to start?
Wow, it is a lot. It is definitely a lot. So let's start with the top. And I think, predictions for 2025. And I'm going to go back to, I'm blanking on who said it, but if you go back and you look at all the people who predicted the future, right, especially with the stock market, whether they were professional predictors or if they were amateur predictors, their ability to predict the future, at least when it comes to what the market does, is minimal at best. Oftentimes, they're not only, not even a little bit right, they're the opposite of right? If you did the opposite of what they said, you would be better off. Having said that, right, there is some value to listening to what these people say, not because of it tells you what the market's going to do, right? Because this isn't Vegas where you can go bet on a number, and if you get the right number, right, then you make out big, right? That's not the world we live in. At least that's not the world that I live in with my clients. Right? I'm not trying to bet what the market is going to do, and I certainly hope that we've created a solid enough financial plan for them that whether the market goes up or whether the market goes down, they're going to be able to hit their income goals. They're going to be able to take those distributions they need, and they're going to be able to sustain it for the next, 20, 30, 40 years, because that is our goal. Our goal isn't about any one year. And so I think, before we get into predictions for 2025, which, while it's important to have an idea of what's going to happen, I think what's more important is to have the right outlook and the right investment approach that is kind of independent of what the market does. Because whether the market goes up or down, you need to have a solid plan. But going back to that original question of predictions for 2025, will the market go up? Will the market go down? What I will tell you, and what is scary, right, is you have Bank of America and several of the other large institutions who have people who get paid, multiple six figures to predict the future of the market. And they have entire teams to do this. And their teams are coming out publicly with the consensus that over the next, 10 years, they see the average market return of being 3% or 4%. Some even, are talking about it being flat and, maybe possibly another dot-com bust. Is that the future? I don't know. But the fact that you have some very well-educated people scared about the future is something to take concern about, right? It's something to take pause about and think about. What I'll also give you anecdotally is the market has had two blockbuster years back to back. We've had 2 years with over 20% returns, which is almost unheard of, right? We don't typically have, two back-to-back years that are really, really high. The United States stock market is also the amount that people are paying for compared the price of stocks compared to the revenue generated by these companies is astronomical, right? It's more than it's ever been historically. And when you compare it to other markets like Europe or Asia or Japan, it is multiples higher, right? So, you usually think about buying a company like I'm going to buy, based on how much money they'll earn over the next 5 years, 10 years, 20 years, 30 years. In the US, we're paying 50 times. They would have to make the same amount of money, the same profit for the next 50 years in order for an investor to recoup their purchase price, which is a little insane, right? Like nobody in their right mind thinks that any of the companies that are around today are going to still be around in 50 years. And even if they manage to be around in 50 years, they're not going to be relevant, right? They're not going to be, Google's not going to be the Google of, 50 years from now, because that's not how the world works. So you got to ask yourself the question, is the price justified, right? Now, fundamentals aside, all of the, numbers and logics, and I can give you charts and I can give you theories and I can give you textbooks. I have an entire, I have bookcases full of books talking about how to price this stuff. What I can tell you is the market is really based on, two things. And this is what Warren Buffett says all the time, right? It's based on human emotion, right? And our expectation, our human emotion and how we react to news. And the way Warren Buffett encapsulates it, he says that the market is driven by fear and greed, right? And when the market is fearful, be greedy. And when the market is greedy, be fearful. And right now, right, for the last 2 years, the market has been extremely greedy. And we've had, whether there's sound reasons for it or not, if you've been listening to our show, you know that there are things happening in the market that are very disturbing, right? That we have an economic shift happening and it's not being reflected in the stock market. But eventually those fundamentals will have to be reflected in something. And when we look at what will the future hold for the market for the next year, I don't know. But I can tell you that at some point, this market probably has to go down. Does it have to 100% go down? No, because people are the ones who drive the price, and people can be euphoric and people can say, well, I want to pay more for it. I think it's going to keep going up. And if enough people think it will go up. Right now, what we have to be worried about is if something comes to light that makes enough people feel that the future is uncertain or that their valuations are unfounded, then the market can tank, and it can tank really, really quickly. And so I think it's very important to remember when it comes to our investments that the market is not driven by rational thought. Right. It's driven by people, and it's driven by people's expectations for the future. And that's what you need to really keep an eye on. So do I think the market, what's my prediction for 2025? I think it's going to be volatile. I think that people are waiting for a consensus as to how Trump will govern and what his effect will be on the economy and how it will be on the market. But I think that trying to predict how people will react to that is a loser's game, right? I don't think anyone can predict that properly.
So with that kind of uncertainty label, what's your advice on safe withdrawal rates for retirees? Should they consider adjusting, how much they're taking out of their portfolios to preserve their nest egg? And should we be also working on the other side at the same time? What about that part?
So that's a really great point and a really great question, right? Ultimately, the stock market is a tool. It isn't about the numbers of where it's going. What it really means to us, at least for us in retirement, or who we're relying on this for our income, is we're not trying to predict the future. What we're trying to do is get a sustainable and predictable income stream in retirement. And I think playing the game of how do we get a predictable and sustainable income stream in retirement is a lot easier to do than predicting where the market's going to go. Because if you build a sound foundation, if you build a sound investment plan, and a sound investment plan means you have a sound income plan, because it needs to answer the question, what money am I going to be living off of first? What money am I going to be living off of second? What's going to be for the future? And if you could answer those questions, then you can make investments that are appropriate for those time horizons, right? So, for instance, with my clients, right, for the money that they're going to be living on for the next few years, I have them invested in things that will have minimal impact on what's happening in the market, right? Market goes up, it's not really going to go up very much. It'll go up a little bit, but it's not really designed to go up. Market goes down, it's not really going to go down either, because it's not designed for that. It's designed to generate income. It's designed to generate stability. For the money that's long into the future, well, what does 1 year make a difference? What matters is the general trend, right? What matters is, are we participating if the market has another 20% year, which could it happen? Yes, it absolutely could happen. Do I think it's going to happen? Probably not, but I'm not an oracle. I don't see the future. I'm not clairvoyant, right? We make investment decisions based on the facts that we have and based on our time horizons. And 1 year is a very small time horizon when compared to the 20, 30, 40 years that we have ahead of us. And so we want to make sure that we make decisions for the appropriate time horizons. And that means having a good income plan, right? We need to know that the money that we're going to be spending in the next few years is not going to be affected by the markets. It's not going to be affected by taxes. It's not going to be affected by, whatever next natural disaster happens or whatever next war happens, right? We need to be insulated from that.
So does it mean that we had the 2008 dot-com bust? Does that mean that our investments should be such, with making history a teacher, that we shouldn't be concerned about another dot-com bust or something similar to that?
We should absolutely be concerned about that. Whether it's a dot-com bust or it's something else, right? Because what I can guarantee you is whatever happens next in the market, the next big catastrophe, is not going to be something similar. It's not going to be similar to what's happened in the past, right? That's always the constant in the market, is that it's always changing, and the next disaster wasn't similar to the previous disaster. So I can tell you, there will be something. How it will affect your investments, I'm not quite sure. What I can tell you is that if we have a good income plan in place where we've insulated and we've created these shields of the money that we're going to be spending for the next few years and the few years after that, if we build enough layers of protection in place, we can weather that storm together, right? And if we're smart about the risks that we take on, right? If we don't just go, and put all of our money into, things that have the potential to go to zero, right? Or things that have the potential to go down 50% or 80% because the market corrected, because the stock market tanked, because, somebody made some decision at the Fed that nobody liked, right? If your investments are designed to have that minimal volatility, then you will be okay, right? And that's really what I think the key is, right? Is not trying to predict what the future will be, because I think that the future is going to be very volatile. I think that is a guaranteed. I think we've got a lot of people, a lot of actors in the market who are trading huge volumes, and they're doing it based on how they feel that morning, right? So
with that as a backdrop, then, Label, what are some tax moves that we should be doing right now with that thought in mind that you just planted on us?
Yeah, so great point, right? If we can't predict the future, then we should take advantage of it, right? We should take advantage of the volatility that happens, right? If the market tanks 20, 30%, right? Or even 10%, you should see that as an opportunity, and you should be ready to take advantage of it. So one of the things that we do constantly for our clients is something called tax loss harvesting, right? When the market goes down, we sell those. We lock in that loss on our tax return, and then we purchase something that's substantially different, right? That is not substantially the same, right? So you have an S&P 500 value fund, we go into a growth fund, right? Or we have the individual sectors or individual companies. You sell Coke, you buy Pepsi, right? Now you own a different company, you will harvest that loss, and now you can use that to offset capital gains that you have down the road. Those are just one of those things. Another thing, if you've got gifting, or if you have things you want to purchase, there's all kinds of tax advantages that you can find in terms of investments, in terms of these behaviors, and you should use them to your advantage. One of the things I send out an alert, and this is one of the reasons why you should be on my email list, is when the market takes a significant enough dive, I send out an alert to do Roth conversions, right? The market's going to recover. Sometimes it recovers the next day. Sometimes it takes a few months. It'll eventually recover because that's what everybody wants it to do. And if you convert it while it's down, you can get a 20, 30, 40% savings on your Roth conversion, which I think is a win, right? As long as it doesn't affect your lifestyle or your income.
That is a win. And we got to leave it right there. But if you'd like more information, you can always visit yields4u.com. That's yields, the number 4, yields4u.com. That's all the time we have for today, and I invite you to join us next week when we talk about big tax moves that everyone should be considering in 2025.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.